Hi, this is Kevin again. I'd like to speak to you a little bit about tax-efficient investing. Where you hold your investments can have a big impact on your after-tax return. You can hold investments in regular taxable or joint accounts or in tax-deferred accounts such as IRAs, 401ks, 403bs, etc. Tax-deferred simply means you don't pay tax on those accounts until you withdraw the money. So an investor can defer paying any taxes on a tax-deferred account until retirement when they'll be in a lower tax bracket. Too often I see new client portfolios that have misplaced investments. In a lot of cases, the client's IRA and taxable accounts will have almost the exact same investments. No consideration was given by the previous investment advisor to tax efficiency, and consequently, much more of the investor's income was paid in taxes than needed to be. There are some investments that perform better after taxes when purchased in a tax-deferred account, and others that perform best when purchased in a regular joint or single-owner taxable account. This has to do with the way the income from these investments is taxed. Some investment income, like dividends and capital gains, are capped at a maximum 15% for most investors, and may not be taxed at all for those investors in the 15% or lower tax bracket. However, there is no such cap on interest income produced from money market, CDs, corporate or U.S. federal government bonds. Income from these sources is taxed at the investor's ordinary income tax rate. So an investor in the top federal income tax brackets would pay 39.6% tax on income from these investments, and potentially another 3.8% Medicare surtax if they qualify. This means that interest from these type of bonds would be taxed at 43.4%. So if you invested in a bond yielding 5%, it's really only yielding 2.8% after tax, and this doesn't consider any state taxes that may be due. When creating a portfolio, always consider the tax consequence of the income that your investments will produce. Again, qualifying dividends and long-term capital gains are tax advantaged. So investments that produce this income, like individual stocks, stock mutual funds, or ETFs, are usually best held in taxable accounts. So an investor in the top federal tax bracket in the above example would pay a maximum 15% on their dividend and capital gains income, and potentially another 3.8% medical surtax. So assuming the same investor earned 5% in dividends or capital gains instead of ordinary interest income for the year, their real after-tax yield is now 4.1%. much better than the 2.8% if that income were taxed at ordinary income tax rates. That's an increase in after-tax return of 46%. That's equivalent to almost $18,000 additional income over 10 years for a $100,000 portfolio. Of course, not all income from bonds is taxed as ordinary income. Municipal bonds are exempt from federal income taxes and therefore are also tax efficient in non-tax deferred accounts. And not all dividend income qualifies for the maximum 15% tax. Any dividends from real estate investment trusts are taxed at ordinary income tax rates and should also be held in tax deferred accounts. In addition, Treasury inflation protected securities produce not only interest income, but also something called phantom income, which is fully taxable. Again, tips are best held in tax-deferred accounts. Remember, always consider the tax consequence of your investments and set your portfolio up for maximum tax efficiency, because it's not how much you make that matters, it's how much you keep. This is Kevin Brocious. Thanks for tuning in.